We're back in business now.
Okay.
Back in business.
Okay.
All right.
And you did the
So
exercise
this
two
is
that we're
exercise
not-
15-2. And this one,
How couldn't you do it with the crossword problems in the slides again?
you guys get the answers anyway.
True.
Okay, so Tom and Julie, they have a management partnership. Fair value of the assets of each invested is as follows. Now, notice that there's office equipment put in here, not here, but Julie has a debt that the partnership's going to take over. Okay?
They're paying her mortgage.
Well, that won't be her mortgage, but it could be something attached to some property that she put in, or
Well, she
whatever.
put 30,000 in land where he put in 30,000 in office.
Right.
So that kind
So
of,
this may be tied to this here. So the net value of the land is 12,000. See
well,
that?
but she also has the cash there too.
Yeah.
But
it's
Tom's put in
40,000.
more,
Yeah, so it really, this doesn't matter a lot, except that this is what they're putting in. This is what they've agreed to put in. So during the year, Tom drew $15,000 out, Julie drew 12, on a profit of 50,000, which is to be allocated based on original net capital investment. Okay. So they allocate this based on capital investment. So we know if we add this up, does that equal this one?
like all of those.
So this is 13, 21, 24, 24, 54, minus 2, 52,000. And this one is 18, 38, 48, minus, well, it doesn't come close. Not even close. But, so they're gonna distribute this 50,000 based on their contribution. So, this is how we set up the company. This is Tom. Tom put in cash, receivables, office supplies, office equipment. Now, they consider this fair value, okay? This is already negotiated, this is fair value. Then he owed $2,000, so he has capital 51,000. Pretty close, we did that in the head. 2 versus 51. Julie, on the hand, she would cash in receivables, office supplies, land, payables of 5,000. Her investment was only 25,000. Okay? And they're going to split that profit based on that relationship. So Tom withdrew 15, she withdrew 12. Those are the journal entries for it. So at the closing time, we put $50,000 in the income summary, right? But Tom's capital gets $33,553 of it. Julie only gets 16 because that's the relationship, 50, 51, the
51
total
to
amount divided by
25.
the ratios. And so, and then he drew 15, and he drew 15, so we closed the draw accounts to the capital accounts. So that's how the journals occurred within the closing. Nothing magical there.
This is complete deja vu of business law.
Yeah, this is very much like business law. If you learn the principles there, most of this will be pretty straightforward. If there are some kind of structures at the end, you probably wasn't covered in business law. You might have. So these are different methods for determining how a partnership might allocate its profits and losses. One of them is a fixed ratio. Chad and I are 50% no matter what. But Judy and I haven't decided yet. I still want 60, she wants 80. Her prerogative, right? Ratio based on capital balances, quite common. Well, the advantage to this one is that sometimes it keeps people from drawing more money out than is reasonable in the investment. So you might, if you're doing capital basis, they want to keep your capital size at you can. Interest in capital investment, fixed salary allocation. Now, what that means is that this is a misnomer if it's a partnership because partnerships, you don't have salary in them for the owners, you have draws. But you could say your draw will be $1,000 a month. Call it salary, but it's a draw. Bonus is a percentage of income, if you do a combination of these two. Okay, so here's another example. T&J, Personal Finance Company, invested $480,000 and $340,000. This is the salaries that they agreed to. John is entitled to bonus 10% net income after salaries and bonus. Now, listen to this carefully because we're going to see how this works. John is entitled to bonus of 10% net income after salaries and bonus, but before interest on capital investment is subtracted. Okay, we're going to see a formula come up that'll do that. It's going to be based on that one line. Each partners receive an interest credit of 8% on the original capital investment. Well, we got a lot of things to consider in this. Remaining profits are allocated 40/60. So on this day, the partnership had net income before salaries, interest, and bonus of $188,000. So this becomes their EBITDA within their structure. Okay, it's not EBITDA in the strict sense we talk about it. Because EBITDA is what? Earnings before taxes, depreciation, and interest, right? Okay. And amortization. So calculate 2008 partnership bonus. So here's the bonus. It's a 10% bonus, and it's income after salaries and bonuses. Okay, so you take this. This is the income after salaries minus B, which is the salaries down here. See that? So this is net income minus salaries, and then equals minus the bonus will equal the actual bonus paid. So bonus equals 10% times 80 minus B. Take the B across the line, right? So we wind up having bonus equals $7,273. That's how we calculate that. So 10% of 80,000 is 8,000 minus 0.1% of B. So you multiply that across, then it becomes $8,000. At 110%, which is 4,270. And this is the information we already got from it. The important thing is that's his bonus. You could actually walk that backwards and come up and determine if that's correct by putting the 7,273 in here, and then it was calculated out. Okay, so this is the important part of the allocation of the profits. Because they agreed to both pay a piece of this amount of money, right? Mm-hmm. Tony wasn't going to get any bonus, but John was. So that's his amount. They were both told that they would get 8% interest on their capital. That's the interest on the capital. So the total of this salary, bonus, and interest is $80,400. $100,000. The remainder is split 40/60, which is this number over here. So each of those Tony gets 40% of the remainder, Jan gets 60%, and this becomes their income allocation.
Okay, so you take 40% of the 180, is that what it is? Or 60% of the 180?
No, you're taking this number right here.
Oh.
See,
okay.
this is the remainder of the 188. So the remainder is 71,270. This is what they were given based on the agreement. Mm-hmm. But the income was 188.
Oh, so.
So okay. The difference between that they have allocated is 7127 on a 40/60 basis.
Okay.
okay?
I see where it came from,
So when you
okay.
add that all together, you have to equal the income.
Where did you get the interest on capital? Where did that come from?
That's the 8% on the, was it 8%? You have to go back a ways, this slide.
Back to 21, yeah, 3.
480,000, 340,000.
Yeah,
And it
it's
was
number
at-
3 of
So is that
8%.
the 8% of the 80,000
Let's see, it was 8% of the original capital investment. The original capital investment was 480 and 340. So this is 8% and 8%. So that's what they were allowed based on the agreement, out of income. So we're assigning that amount of income to each of them on that basis. Okay, so these added up. This is their salary. This is the bonus paid for John. This is the allocation based on agreement.
Okay, so why is it that Tony's getting less even though he invested more?
Which one is investing more?
Tony invested
Tony
more.
invested more, so he's getting 38.4 versus 27.2, which is correct.
Okay.
They're both 8%.
Yeah, but the remainder, John gets more.
Because he got the bonus up here. That's part of the reason. And then the allocation is only 40/60. So John gets a better relationship because he gets the bonus and he gets 60%.
Okay.
So the difference makes up the difference down here. Plus, John also got 66,000 salary where Tony only got 42. So this agreement's really lopsided towards John.
And he was the one that invested the least.
And he invested the least. But obviously, John is, between the partners, is bringing something to partnership that Jan can't, or Tony can't bring. So it's worth more to Tony to give more to John, because maybe he's a stronger partner, maybe it's his expertise, maybe it's his product that they're selling. There's lots of things. We don't know, it doesn't describe that. But the important thing is that this is written, and so when it comes time to do something, it's specific. There's no questions, you know, there's no argument, because that's what they agreed to and signed for. Okay, so if there's insufficient income to cover the allocation, there are some things that have to happen with that too. So that income is 11,000, but it would be allocated this week because they agreed to 4,000 and 2,000, an interest of 62,000 and 3,000. But they wind up with 66,500 and 15, but there's only $11,000 available. Say, this is what they agreed to get. But when it comes down to it, there's only $11,000 to give, so that they have a negative balance. So they allocate it to them, in this case, based on 50%. And you might say that is allocated based on 60/40 or some other method. In this case, they split it. They split losses. You might have a loss relationship division separately from the profit. So you might have two types of allocations there, depending on the agreement. Okay. Now, a lot of times the salaries and wages, most of the time are not even in the partnership. But you can, as a way of treating, you can treat them as salaries and wages to easily control them. Effectively, they're draws on it. So, and the reason you might want to do this is the same change in capital accounts as salaries and interest are considered in the allocation of profit. So that's one reason you may want to do that. Amounts treated as expense should be disclosed, meaning that if you do a set to the bank, you need to tell them how much the salaries and wages is actually partner draw.
So when you have like when you do up your contract sheet, you go and not only cover like your gains, but also how you're splitting the losses. Is that what it was? Is that what you meant in the earlier slides of splitting the gains and the profits and losses in the contract?
I think I missed something.
Okay, In the earlier slides, you were talking about the profits and losses of what to make sure you have in the partnership agreement. So if you like divide it up that way in the profits, you've got to make sure you, with the losses, you have it divided up the same way. And written in
Or
the
a different
contract.
method, but at least it's spelled out.
Okay.
Okay. So it's normally you'll see profits and losses are split on the same basis.
Mhm.
But they wanted to show you what would happen if it was a different basis on that slide.
Okay.
Disclosure, when you do your financial statements, becomes more and more important the bigger you get. Sometimes you're going to sit down at the bank and you're going to hand them the financial statements. And you're going to sit there and say, oh, well, what does this mean, John? What is included in here? Are there any salaries and a banker's note, right? Questions. They may want to say, well, there's a lot of interest in here. Who are you paying the interest to? Why would a banker ask that question?
See if you can make the payment.
Well, that too. In fact, that's a very good point. The other thing is they want to see if you're making interest payments to other people.
If you're paying other people off and being in the red.
Well, you might have other loans that he's unaware of.
Mhm.
And it kind of points you to go back and put out balance sheet. There's a lot of questions he's going to ask. You think the bank would ever say to you, you guys are really growing fast. Is there any way we can slow it down?
I bet
No.
so.
They would never say that.
They wouldn't?
I bet they would.
No, as long as you're paying the payment and you're able to show that you're growing and making a profit and that they're gonna get their payment, they'll give you the money.
I'm betting it's happened before. That's why you brought up the question.
It happens. In this town, I was the controller of a company. We were growing like a weed. And the banker said to me, sure wish you guys would slow down. Don't like these rapid growths. Problem is that it's in a rapid growth situation is your capital can't keep up with the growth of the company. So you get to where you can't pay your bills. Now eventually it reverses and comes back around when you start slowing down again. A lot of times what happens is you start to grow so fast, your capital investment has to be for equipment and so forth, has to be ahead of it. And so you're constantly adding debt to your structure, and debt is damaging to the growth of the company. There are a lot of companies that grew too fast and caused real problems. There are public companies now. Facebook is kind of one of those actually. Growing too fast.
Yeah, he like overcompensated on his stock.
So yeah, it's possible to go to a banker or to an investor and say, and they'll say, I think you guys ought to slow down a little bit, kind of let life go on first. Very common. Okay, adjustments for prior years. Now, can you remember about 4 months ago when we talked about errors?
Like errors in the balance
Errors in
statements?
accounting. And we have two kinds of errors. One of them is error is a principal change. The one's an estimate change. We handle it differently. We went through this, I guess about a week ago too.
Aren't you supposed to go in and like if you hit it like, did you do the example of like you like charged like $1 or something like that, and then you found out that it was actually $1.50? Wasn't that like an example that you did on it? Or am I not thinking
Don't remember
right?
that one. That was some other class.
No, was it? It was your class.
I can't remember it. When you have an estimate, generally, you only take care of the estimate in the year that it occurs. If you have a change in principle, meaning you had to, in previous years you handled it this way, and now you have to handle it this way because the principle changed, then for any financial statement you present, you have to go back and show the effect of that principle change for all presented financial statements. So you have 3 years, you go back 3 years to show the effect
So if you,
on that principle change.
so like you have, when you change it, you have to go back until, if like you had more than 3 years, do you have to go all the way back, or is it just
As
a
many
max
years
of
as
3
you present. Now, typically, you're going to show 2 years of balance sheet, 3 years of financial statement, income statement. But that's the general rule. Now, if you find errors in prior years and the partners have altered the profit and loss agreement since the period in which error occurred, corrections are allocated to the partners' capital accounts. Okay, so in this case, we're just going to change the difference between the partnerships and how that works. Now, we're dealing with partnerships now, we're not dealing with corporations in this case. I just wanted to review the principal estimate subject with you again to renew that, okay? So that you remember that. Okay, this kind of goes into that. Change the differences in GAAP. Change in partner's equity should be disclosed. Salary allowances are generally not an expense in partnerships, remember? No income tax expense in a partnership, right? Pass through to the partners. So any income is split to the partners and they pay based on their tax rate. If you're worth $250 million, and your partner's worth $100,000, obviously your tax rate's going to be different, right?
No, not always, depending on the loopholes.
Not always, but excuse me.
Bless you.
For all discussion here, we're going to say that you are. If you're at Romney, you might be less because he's got his already taxed before. Interest allowance on capital accounts is considered an allocation of profit. Okay, allocation of profit. Okay. This is how we present financial statements. This is my presentation. Obviously, in this period, they hadn't formed yet. First that year, and then but they invested these amounts, and they allocated the income based on the percentage. So now their totals are this column and that and so forth, less the draws that they made. So this is what their capital accounts are at the end of the period. They might have shown this as salary. If they did that, then it would have reduced this and this, right? We have to take them out and show that before salaries, and then put them in as draws. This is probably a good time to take a break.
Okay.
We're going to start talking about dissolution partnerships. We're 5 minutes early, if that's okay.